Listen carefully, because what happened on January 9th wasn't a big day for silver. It was the sound of a system clicking into its next phase. And if you're still thinking this was just a spicy headline, just another spike, just another pullback, then you're about to get blindsided by the part most investors never see coming. The move that looks random right before it becomes inevitable. Here's the first open loop, and I'm going to close it later in this video. There's one specific reason silver moves like this at the end of a monetary cycle, and it's not the reason people argue about in comment sections. It's mechanical, it's repeatable, and once you see it, you can't unsee it. Now, the authority check, because this isn't vibes. As of the third quarter of 2025, global debt was reported near $346 trillion, roughly 310% of global GDP, according to the Institute of International Finance, as covered by Reuters. And the IMF has repeatedly flagged that total global debt remains above 235% of world GDP in its global debt database commentary. That is not a number. That is a constraint, a trap. Because when debt grows faster than real output for long enough, the system eventually has to choose between two outcomes it hates, default or debasement. Default breaks politics. Debasement breaks currency. And the system almost always chooses debasement until it can't disguise it anymore. And when the disguise fails, precious metals don't politely trend up. They reprice, violently, discontinuously, in gaps that make most people emotionally freeze, waiting for a dip that never comes, until the dip comes after the price is already doubled. Now, watch how January 9th fits into this. On January 9th, 2026, silver surged and briefly pushed above $80 per ounce in the wake of a weaker U.S. jobs report, exactly the kind of macro spark that lights a tinderbox market. Forbes reported the move as silver surpassing $80 after weak job creation. Reuters also tied precious metals' strength to the weaker payrolls data and uncertainty. But here's what matters. Silver didn't just spike. It snapped back with force after volatility earlier in the week, like a market that refused to stay down. And then late January happened. On January 26, 2026, the Wall Street Journal reported silver surged about 14% in a single day, the largest daily gain since 1985, alongside record highs in gold. Barron's has been openly emphasizing what serious investors already know. Silver is far smaller and less liquid than gold, so relatively modest flows can move it violently, which is why volatility becomes a defining feature in these runs. So here's the cold statement you need to absorb. January 9th wasn't the event. It was the signal that the event sequence had begun. Now I'm going to lay out the mechanism. No conspiracy theater, no mystical forecasting, just a pattern so consistent across history that it behaves like physics. First, there's always a foundation phase. A credible order is built, the currency is trusted, the system feels stable, credit expands, people stop preparing for breaks because breaks haven't happened recently. Second, expansion becomes overextension. Debt multiplies. Promises pile up faster than real value can support. The currency is diluted, sometimes slowly, sometimes aggressively, sometimes under new names like stimulus or liquidity support. The public tolerates it because it feels gradual and the narrative is comforting. Third, the crisis phase arrives when reality demands payment. Inflation threatens, growth wobbles, political tensions rise, and the managers of the system lose control of the levers they use to smooth volatility. They start oscillating. Tighten, rescue, because there is no painless option. And fourth, the inevitable outcome, the unit of account breaks psychologically. People stop trusting the measuring stick. They start measuring life in real things, energy, food, land, and historically monetary metals. Not because metals are magic, because metals are outside the promise network. This is where silver becomes dangerous, not because it's shiny, but because it sits at the intersection of industry and money. It's needed in manufacturing, and it's feared in currency crises. When both sides pull at once, the market doesn't glide, it jerks. Now we prove this. 3 different eras, same machine. First, Rome. And I want you to picture this because it's the easiest way to understand what a currency system really is. Rome's early imperial order had credibility, military dominance, tax inflows, trade routes, and a coinage system people accepted because it worked. That's the foundation. Trust is high. Commerce expands. Then the empire grows. Armies are permanent. Borders are expensive. The state's obligations become larger than its honest revenues. That's overextension. And then comes the quiet choice Rome made again and again: alter the coin. Debasement. Not in a dramatic overnight announcement. In a slow reduction of silver content, repeated over time, so the empire could meet obligations without openly admitting it couldn't. And this is the key moment most people miss. The first time debasement happens, it feels like a hack, a clever trick, a way to manage costs. But the second time it happens, it becomes policy. And by the 10th time, it becomes destiny. Then the crisis phase arrives. Prices rise, shortages appear. People don't need charts to know the money is weakening. They feel it. Merchants demand more coins. Soldiers demand higher pay. The empire responds by debasing again to pay the higher costs created by debasement. This is the loop. It is self-feeding. And the outcome? Trust fractures. People hoard older, higher quality coins and spend the weaker ones first. Real wealth migrates into hard goods and metal, and the empire's coordination costs explode because money is coordination. When money is dishonest, everything becomes harder, slower, angrier, different era, same pattern. Now Germany after World War I. This one is the speedrun version. Before the war, the mark functioned as a unit people could plan around. Savings meant something. That's the foundation. Then the obligations arrive, war debts, reconstruction, and the reparations pressure that poisoned political stability. The state faces an impossible choice. It can default, which detonates society, or it can print, which delays pain but compounds it. So it prints, it expands credit, it tells itself it's temporary. That's overextension. Then the crisis phase hits when the public realizes the currency supply is rising faster than real goods. This is where hyperinflation is misunderstood. It's not only too much money. It's the moment trust breaks and velocity takes over. People spend immediately because holding money feels like holding ice in your hand. At that stage, the central bank isn't steering. It's being dragged behind a population stampeding away from the currency. And the outcome is brutal. The unit dies as a store of value. People start measuring life in anything else. Commodities, foreign currency, tangible goods. The winners aren't the loudest. The winners are the positioned. The people already holding real assets before the psychological break. Again, foundation, overextension, loss of control, then repricing into real things. Now the third case study, the United States and the modern blueprint. Because this is the one investors think they understand, but they usually don't. After World War II, Bretton Woods created a credibility machine. The dollar sat at the center, tied to gold convertibility for foreign governments. The US exported stability, and the world built around it. That's foundation. Then overextension arrived. War spending, domestic programs, trade imbalances. The claims on US gold grew larger than the gold itself could support at the promised price. The system kept running because belief kept it running. Then the crisis. In 1971, the gold link was severed. The Nixon shock. The promise broke. Not instantly catastrophic, but structurally irreversible. The world shifted from a constraint-based monetary system to a narrative-based one. And what followed? A decade that taught the real lesson. Inflation surged, growth struggled, confidence became volatile, and hard assets repriced because the measuring stick was bending. Gold exploded. Silver behaved like silver. It lagged, then it launched, because when monetary fear hits a metal with a small market and industrial demand, the move can become discontinuous. Now, keep those three examples in your head like three identical machines built in different centuries. And now we apply the pattern to the present, step by step, without speculation, just matching. First, foundation, modern edition. After 2008, the system rebuilt confidence through emergency policy. Near zero rates, quantitative easing, liquidity facilities, explicit backstops. Markets learned a new religion, the idea that the central bank could stabilize everything. Risk was rewarded. Leverage became normal. Asset prices inflated and were sold as recovery. That's the setup. Credibility plus complacency. Check, verified, undeniable. Second, overextension. Once you convince the world you can't allow collapse, you guarantee the world will build a structure that requires constant support. Government deficits become chronic because austerity is political suicide. Corporations roll debt because refinancing is easier than discipline. Households stretch because the cost of living pressures squeeze them. And globally, the debt pile sits at a level so high it turns normal interest rates into a threat. This is why the global debt statistic matters. Nearly $346 trillion, roughly 310% of GDP. Late 2025, reported via the IIF and covered by Reuters. The IMF warning that global debt remains above 235% of world GDP reinforces the same structural condition. That's not a cycle, that's a dependence. Check. Verified, undeniable. Third, crisis, expressed as loss of control. This is the part where people get hypnotized by headlines. They look for a single cause, jobs reports, elections, wars, tariffs, shutdowns, central bank meetings. But those are sparks. The fuel is systemic. When the system is overleveraged, it cannot tolerate prolonged higher rates, tighter liquidity, or political shocks without something snapping. So policy oscillates, tighten to fight inflation, then rescue to prevent instability, then tighten again because inflation returns, then rescue again because something breaks. And this oscillation leaks confidence. Because the public can feel the truth the narrative tries to hide. There is no painless choice, only different flavors of pain. Now, watch silver as a stress monitor. On January 9th, silver surged and pushed above $80 as macro expectations shifted after weak job creation. That's not just a number, that's a reflex. Investors shifting toward hard assets when the credibility of policy guidance wobbles. And then January 26th happened. A 14% one-day move to record territory, biggest daily gain since 1985, reported by the WSJ. You don't get moves like that in a calm, controlled environment. You get them when liquidity is thinner than people assume, when positioning is crowded, and when the marginal buyer becomes urgent. Barron's has been explicit about the liquidity problem. Silver's market is far smaller and less liquid than gold, so flows that would barely move, gold can move silver by dollars. And that's why volatility becomes a feature, not a bug. This is stage 3. The managers start losing the ability to smooth the surface. Check. Verified. Undeniable. Now, stage 4, the outcome. And this is where I'm going to say something that will upset people who want a neat, comfortable thesis. The outcome isn't silver goes up forever. The outcome is that the market changes character. It shifts from a world where price discovery feels steady to a world where price discovery becomes episodic. Calm, then violent. Quiet, then explosive. Pullback, then a snap that leaves everyone behind. That's why January 9th matters. It wasn't just a rebound. It was a personality test. Sell pressure hit, confidence was tested, and silver snapped back. Then, weeks later, silver printed a historically extreme daily move. That sequence is what late-stage repricing looks like. First, the market proves it won't die. Then it proves it won't move politely either. Now I'm going to close the open loop I gave you at the beginning. Why does silver act like this near the end of these cycles? Because silver is the metal that turns monetary stress into a liquidity event. Gold is deep. Gold is institutional. Gold moves, but it can absorb flow. Silver is smaller. Silver is more industrial. It's used in electronics, solar, manufacturing, real-world demand that doesn't pause just because traders are nervous. And when monetary fear shows up at the same time, the market can go from plentiful to tight, psychologically in a heartbeat. That's not mysticism. That's structure. And it creates the trap that crushes retail investors. Silver can spend months doing nothing, teaching you patience in the wrong direction. Then it moves so fast that if you try to wait for confirmation, you become the buyer at the top of a spike or the seller at the bottom of a panic. So what do you do, practically, if you're not here for entertainment but survival? First, you stop telling yourself comforting stories. You dismiss American exceptionalism as a shield against arithmetic. Empires don't outrun the math. They only delay it. You dismiss technology will save us, thinking as a substitute for balance sheets. Technology can increase productivity, yes, but it cannot unprint promises already made. It cannot remove political resistance to austerity. And it cannot change the basic rule. When claims expand faster than reality, the measuring stick bends. You dismiss the fantasy that central banks achieved permanent mastery over cycles. If mastery existed, you would not see historically extreme moves in silver alongside public debt dependence and policy oscillation. You would not see mainstream outlets describing bubble fears, volatility concerns, and liquidity constraints as part of the silver story in real time. Now, actionable insight. Not hype, not cosplay. Treat silver as part of a defensive architecture, not a lottery ticket. That means you assume volatility, you assume pullbacks. You assume headlines will try to explain the move with whatever narrative is convenient that day. You assume some rallies will look too high right before they go higher, and some drops will feel fatal right before they reverse. So you build exposure with a plan that survives emotional chaos. Size that won't force you to panic sell, time horizon that doesn't require weekly validation, and risk controls that don't depend on perfect timing. And you train your mind to recognize stage behavior. When you see global debt structurally elevated, stage 2. When you see policy oscillation and credibility stress, stage 3. When you see silver stop behaving like a sleepy commodity and start behaving like a referendum on the measuring stick, stage 4 is opening. January 9th wasn't just a candle on a chart. It was the sound of the door unlatching. And here's the final warning. The pattern is absolute. It doesn't care about your opinion, your optimism, or your skepticism. It doesn't care how many influencers say the rally is overextended. Overextended is what stage 4 looks like to people who arrived late. The only real question is whether you see the machine before the crowd does, because the crowd doesn't position early, the crowd reacts late. And when silver reprices, late reactions are punished, first by speed, then by regret. So if you want the next piece, how the machine was built, why volatility is not a side effect but a signal, and what the next stage looks like if this turns from a rally into a systemic repricing, subscribe now, follow now, follow. And watch the next video, because the people who wait for certainty don't get safety, they get receipts.